Hey everyone, and welcome back to the channel. Today we're diving deep into a topic that's got everyone on the edge of their seats: the wild, wild world of the silver market. Over the past few days, we've witnessed some truly unusual dynamics, things that are making even seasoned traders raise their eyebrows. Price movements that would normally fly under the radar are now under intense scrutiny, and that's because multiple powerful forces are all crashing together at the same time. Right now, as I'm recording this, silver is trading in a tight range between $85 and $90 an ounce. Now, you might be thinking, what's the big deal? Well, the big deal is that just days ago, silver hit a spectacular all-time high of $121.64. That means we've just experienced one of the sharpest, most brutal short-term drops in modern market history. It's the kind of move that leaves a lot of people scratching their heads and, frankly, feeling a bit of whiplash. But here's where the story gets really interesting. Despite this insane price volatility in the paper markets, the underlying physical fundamentals of silver, the real-world supply and demand, remain surprisingly strong. Think about it. Industrial demand for silver, which is a huge component of its use, is still running hot. Companies need it for everything from solar panels to electronics. At the same time, the big COMEX warehouse inventories, where a lot of the deliverable silver is stored, are still looking pretty thin. We're not seeing a flood of new supply hitting the market. On top of that, global supply chains are still dealing with constraints. We're seeing ongoing issues, particularly in key mining regions that have export limitations or other logistical hurdles. So you have this strange and fascinating picture. The paper price of silver is on a roller coaster, while the physical market is telling a story of scarcity and steady demand. This massive split, this divergence between the paper price and the physical reality, creates a really complex puzzle for anyone trying to figure out where we go from here. It's like two different markets are telling two completely different stories. This brings us to the critical zone we're in right now, that $85 to $90 range. This isn't just some random number. In the world of technical analysis, this area is what we call a major pivot point. It's a level where historical support and resistance lines all crash together. When you look at the charts, you'll see multiple moving averages, key indicators that traders use to gauge market trends, are all intersecting right in this very region. This convergence of technical factors basically supercharges the importance of this price level. It acts like a powerful magnet for price, and what happens here could set the tone for weeks or even months to come. So where does that leave us? Market participants, from the big institutional players to the small retail investors, are all standing at a decisive crossroads. We're at a true inflection point. There are really only two primary paths forward from here. The first possibility is that the price stabilizes. The panic selling we've seen subsides, cooler heads prevail, and buyers step back in, recognizing the strong underlying fundamentals. The market could find its footing right here in this $85 to $90 zone, consolidate for a bit, and then begin its next move. This would suggest that the recent drop was a sharp but necessary correction in an otherwise bullish trend. But there's another, less optimistic scenario. If the downward momentum continues, if the fear and panic win out, then this support level could break. If we fall decisively below $85, it could trigger another wave of selling. In that case, we would be looking at the next major area of structural support, which, according to the charts, sits somewhere down around the $75 mark. A test of that level would certainly be a painful experience for anyone holding long positions and would signal a more significant shift in market sentiment. So, what are the forces driving this volatility? It's a cocktail of factors. First, you have large speculative funds who are trading on momentum. They might have been long on the way up to the all-time high and are now aggressively shorting the market on the way down, amplifying the moves. Their goal is to profit from the volatility itself, regardless of the long-term fundamentals. Then you have the industrial users. They might be seeing this price drop as a golden opportunity to lock in their silver supplies at a cheaper price, which could be providing some of the support we're seeing in this $85 to $90 range. And of course, there are the retail investors. Many have been drawn to silver as a hedge against inflation and economic uncertainty. The recent price action has likely been a nerve-wracking experience for many. Some may be panic selling, while others, often called the diamond hands, are holding on or even buying more, believing in the long-term value proposition of physical silver. This clash between different types of market participants, each with their own goals and time horizons, is what's creating this incredible tug-of-war. What's truly fascinating is how this disconnect between the paper and physical markets can persist. The paper market, which includes futures contracts and ETFs, can be influenced by massive amounts of leverage and speculative capital that have little to do with the actual physical metal. A large fund can sell billions of dollars worth of paper silver contracts without a single ounce of physical metal ever changing hands. This can temporarily suppress the price, even when physical demand is soaring and supply is tight. However, these disconnects usually can't last forever. At some point, reality has to bite. If industrial users and investors continue to demand physical delivery of silver, and the warehouse inventories keep draining, it puts a squeeze on the paper market. This is the scenario that many silver bulls have been waiting for, a moment where the physical demand overwhelms the paper manipulation and forces the price to reflect its true scarcity. Whether this recent volatility is the beginning of that process, or just another short-term fluctuation, remains the $1 million, or perhaps the $90 question. So, as we move forward, the key things to watch are simple. Keep an eye on the COMEX inventory levels. Are they continuing to shrink, or are we seeing a surprise influx of metal? Watch the premiums on physical silver coins and bars. High premiums are often a sign that demand for the real thing is far outpacing the paper spot price. And of course, watch the price action itself. Will the $85 level hold as a solid floor? A strong bounce from this area would be a very bullish signal. A break below it would suggest more pain is ahead. This is a defining moment for the silver market. The extreme volatility is shaking out weak hands, but the underlying story of strong fundamentals remains firmly in place. It's a complex and dynamic situation, and one that promises to deliver plenty more surprises in the days and weeks ahead. We'll be tracking it every step of the way right here on the channel. Thanks so much for tuning in. This is a rapidly developing story, so make sure you're subscribed with notifications turned on so you don't miss our next update. Drop a comment below and let me know your thoughts. Are you a buyer, a seller, or just watching from the sidelines? Stay safe, stay informed, and I'll see you in the next video. Hey everyone, and welcome back to the channel. Today, we're diving deep into the silver market, but with a twist. We're not just looking at charts, we're decoding the complex signals that are setting the stage for some serious price action. The big picture, the macro environment, is throwing a lot of uncertainty our way, and that's making markets nervous. But right now, all eyes are on one specific event that could be the trigger for Silver's next big move, the upcoming January employment report. This report is a huge deal. It's not just a number, it's a story about the health of the US economy, and the Federal Reserve is reading every single line. The market consensus is expecting some moderate job growth, kind of a Goldilocks scenario, not too hot, not too cold. But what if the consensus is wrong? That's where things get interesting for silver. A deviation, either stronger or weaker than expected, could send shockwaves through the US dollar, and as you know, the dollar and silver have a very intimate, often inverse relationship. Let's play out the two main scenarios. First, what if the jobs data comes in hot? A blowout report with way more jobs created than anyone predicted would scream strong economy. For the Fed, that reinforces the idea that they can keep interest rates higher for longer to fight inflation without crashing the economy. Higher rates make the dollar more attractive to investors, causing it to strengthen. A stronger dollar typically puts downward pressure on precious metals like silver, which are priced in dollars. So, strong labor data could mean a tough time for silver prices in the short term. Now, let's flip the script. What if the jobs report is a dud? Weaker than expected data would signal a cooling economy. This would give the Federal Reserve a reason to consider cutting interest rates sooner rather than later. The market would start pricing in a more dovish policy, which is music to the ears of silver bulls. The prospect of lower rates tends to weaken the US dollar and makes non-yielding assets like silver more appealing. In this scenario, weak labor data could be the exact tailwind silver needs to break out to the upside. So, you see, this one report is a major fork in the road. But it's not just about the jobs report. To get a real edge, we need to look at what the big players, the smart money, are doing behind the scenes. And for that, we turn to the futures and options market. Specifically, we're looking at the March 2026 contracts. What we're seeing here is fascinating. It's not a story of overwhelming bullishness or bearishness. Instead, it's a story of preparation for volatility. Traders aren't making a firm bet on which way silver will go. Instead, they are bracing for a big move in either direction. How do we know this? We're seeing a sharp expansion in open interest for both call options, which are bets on prices going up, and put options, which are bets on prices going down. When you see activity increasing on both sides like this, it's a clear signal that the market is anticipating a significant price swing. It's like everyone is buying a ticket for the roller coaster, but they're not sure if the first big drop will be up or down. This accumulation of positions, especially as traders roll their existing bets forward into later contracts, tells us they expect this period of uncertainty to resolve with a bang, not a whimper. They're positioning themselves to capitalize on a major breakout, regardless of the direction. This isn't about long-term conviction just yet. It's about short-term tactical positioning for a volatile event. To get even more granular, we need to pay close attention to the commitment of traders, or COT report. This data is going to be incredibly revealing in the coming weeks. The KOT report breaks down the positions of different types of traders, and we're particularly interested in the commercials. These are the large institutions, the producers and industrial users of silver, who are often considered the most informed players in the market. Historically, commercial traders are net short, meaning they are hedging their physical silver holdings. But it's the changes in their positioning that give us clues. If we see a significant reduction in their short positions, it could suggest that these insiders believe the price is nearing a bottom or is about to stabilize. They feel less need to hedge against a price drop. That would be a very bullish signal. On the other hand, if we see them maintaining or even increasing their short exposure, it signals continued caution. It tells us that the institutional players are still worried about potential downside and are actively protecting themselves. This would suggest that any rally might be short-lived and that the path of least resistance could still be lower. Why does this positioning matter so much? It's all about liquidity flows and the mechanics of the market. These large positions can amplify price movements. For example, a sudden price spike could force those with large short positions to buy back their contracts to cover their losses, which adds more buying pressure and pushes the price even higher. This is a classic short squeeze. The reverse can happen too, with a price drop triggering forced selling and margin calls, accelerating the decline. These dynamics, driven by hedging activity and adjustments to massive positions, create feedback loops that can turn a small move into a major trend. So let's tie this all together. We have a major economic catalyst on the horizon with the January employment report, which has the power to dramatically shift Fed policy expectations and move the US dollar. We have the options market telling us that traders are not committed to a direction, but are fully prepared for a massive spike in volatility. And we have the KOT data providing a window into the minds of the most informed commercial players, whose actions can either support a price recovery or signal more trouble ahead. The current environment is a coiled spring. The tension is building, and the combination of macroeconomic uncertainty and speculative positioning is creating a powder keg. While the long-term fundamentals for silver remain compelling, the short-term path is all about navigating this impending volatility. The key takeaway here is to be prepared. The jobs report will be the initial spark, but the subsequent moves in the options and futures markets will tell us if that spark is going to fizzle out or ignite a major fire. This isn't a time for complacency. It's a time for vigilance, watching these key indicators, the jobs number, the options open interest, and the commercial positioning in the KOT report will be crucial for understanding silver's next big move. Forget trying to predict the exact direction for a moment, and instead focus on the fact that the market is telling us to expect a significant price swing. Whether that presents a buying opportunity or a signal to be cautious will become much clearer once the dust from this jobs report settles. Thanks so much for watching today. I hope this deep dive helps you make sense of what's happening in the silver market. If you found this analysis valuable, please hit that like button and be sure to subscribe and turn on notifications so you don't miss our next update. I'd love to hear your thoughts in the comments below. Are you bullish or bearish on silver right now? Let me know. Until next time, trade smart and stay informed. Hello everyone, and welcome back to the channel. Today, we're diving deep into the silver market, a space that's showing some fascinating and frankly confusing signals right now. If you've been watching the charts, you've seen the recent sell-off. But if you've tried to buy physical silver, you've probably noticed something strange. The prices for coins and bars are still surprisingly high. What's going on here? This is the core of what we're exploring today, the growing split between the paper price of silver and what's happening in the physical real world. Let's start with the most obvious clue, those high premiums on physical silver. A premium is the extra amount you pay over the spot price you see on financial news channels. Right now, despite the spot price taking a hit, those premiums are staying elevated. This isn't just a minor quirk, it's a huge signal. It tells us that demand for the actual metal, the kind you can hold in your hand, is persistent and strong. People are still buying, and they're willing to pay more to get it. This suggests that the prices you see on exchanges, the paper prices, aren't telling the whole story. They don't fully reflect the real-world patterns of consumption and accumulation that are happening behind the scenes. So how do we get a clearer picture? We need to look beyond the spot price. We need to monitor things like these physical premiums, the spreads between what dealers will buy and sell silver for, and any limits they put on how much you can buy at once. These are our real-time gauges. They measure the stress on the supply chain and the true resilience of demand. When premiums are high and dealers are limiting sales, it means supply is tight and demand is outstripping what's easily available. It is a much more grounded view of the market than just looking at a fluctuating number on a screen. Now, this isn't the first time we've seen this kind of disconnect. History gives us some valuable perspective. Think back to major market moments like 1980, 2011, and even the turmoil of 2020. In each of these cases, we saw similar patterns play out. First, there's a sharp, often scary decline in the paper price. This triggers a heightened emotional response from investors: fear, panic, and a rush to sell. But what happened next? The market eventually found its footing. It stabilized either through a strong recovery, a period of sideways consolidation, or by forming a double bottom pattern where the price tests a low point twice before moving back up. The key takeaway from these historical events is that even when paper prices were going wild and overshooting to the downside, the fundamental drivers of the silver market remained intact. The real-world demand for industrial use, for investment, for jewelry, all of that didn't just vanish overnight. And the realities of mining and refining, the supply side, also continued along their path. The paper market was having a moment of panic, but the physical market was still chugging along, governed by its own set of rules. We seem to be witnessing a similar dynamic today. This brings us to the powerful role of human behavior in the current market. Let's be honest, rapid price drops are a gut check for even the most seasoned traders. They challenge your conviction and test your risk management discipline to its limits. When prices fall fast, it can trigger a cascade of reactions. Panic-driven selling starts to take hold. Traders who use too much leverage, borrowed money, get hit with margin calls, forcing them to sell their positions at the worst possible time to cover their debts. This forced selling adds fuel to the fire, amplifying the short-term volatility and pushing prices down even further than they might otherwise go. To understand the market right now, you have to watch how different groups are behaving. You have the commercial hedgers, like miners and industrial users, who use the futures market to lock in prices. Are they buying or selling? Then you have the big speculative funds, the hedge funds and money managers. Are they piling into short positions, betting on further price drops, or are they seeing this as a buying opportunity? And finally, you have the retail investors, people like you and me. Are they panic selling their ETFs, or are they the ones driving up the premiums on physical coins and bars? Watching these different behavioral responses helps us identify where the pressure is building and how liquidity is being distributed throughout the market. It's a complex dance between fear, greed, and strategy. So where does this leave us? We're currently in what I'd call a compressed analytical window. It's a moment where everything is converging and coming to a head. We have the technical chart patterns, the macroeconomic data like inflation and interest rate decisions, the positioning of different trader groups, and that all-important physical demand we've been talking about. All these factors are intersecting at once, making the next few weeks absolutely critical. Let's talk about some key levels to watch. If we see the price of silver find and hold sustained support in that $85 to $90 range, that would be a very positive sign. It would suggest that the market has absorbed the recent stress, that the panic selling has exhausted itself, and that buyers are stepping in to establish a new floor. It would indicate that the underlying strength of the physical market is starting to reassert itself over the paper market's volatility. On the other hand, if we see decisive breaks below that level, it could expose remaining vulnerabilities. It might mean there are still a lot of leveraged positions that need to be unwound, and we could see another leg down before the market finds its ultimate bottom. That's why it's not about making a speculative forecast or a wild guess. It's about being a detective and continuously monitoring these intersecting factors. The clues are all there: the premiums on physical silver, the behavior of different market participants, and the reaction at key technical levels. These are the pieces of the puzzle. Putting them together gives us the most reliable framework for interpreting how the market is likely to evolve in the near term. It's about understanding the deep-seated tension between the paper and physical markets. The paper market can be driven by algorithms, leverage, and short-term sentiment, but the physical market is driven by real people, real industries, and the finite supply of a real-world commodity. Right now, these two worlds are telling very different stories. The big question is, which story will win out in the end? History suggests that fundamentals and physical realities tend to triumph over short-term paper fluctuations. By staying informed and looking at all the data points, not just the headline spot price, you can navigate this complex environment with more confidence. The divergence we're seeing is a powerful reminder that there's often more to the story than meets the eye. Keep an eye on those premiums, watch the behavior, and pay attention to those key support levels. That S how you all gain a true understanding of what S really happening in the silver market. Thanks so much for watching today. I hope this analysis helps you make sense of the current market action. If you found this video helpful, please give it a thumbs up and don't forget to subscribe and hit the bell so you don't miss our future updates. I'd love to hear your thoughts in the comments below. Are you seeing high premiums in your area? What's your take on this paper versus physical debate? Let's continue the conversation. Until next time, stay safe and invest wisely.